So the network is not friendly here. So we'll be talking about business income, part 2, capital allowance. I was making a point that capital allowance is one of the big area in the syllabus. And one thing about it is time wasting. In the exam, capital allowance question is, if you are asked to compute capital allowance, any question like that is a big time waster. So what I will advise, if it is coming out in the essay part, just do the bits you can within the time you have allotted for it. Don't bother trying to do everything. So that means you have to learn to be fast. You also have to learn to be proficient in computing capital allowances. Okay, so let me walk you through on what to expect in capital allowances. Now, these capital allowance rates will be given to you in the exam. To be given to you in exam. So while you are waiting for it to be given to you, work with these ones and learn how to use it. Now, look at the rates. The popular ones here is the office equipment, motor vehicle, perhaps office building, furniture and fittings, plant and machinery. These are some of the popular ones you get in exams. Now you see initial and annual. What do they mean? Initial rates, initial capital allowance, and annual allowance. What do they mean? And what do investment allowance mean? Okay, now let me tell you what let's start with investment allowance. Investment allowance is the type of capital allowance that is only allowed on plant and machinery. It's only allowed on plant and machinery. That means if you have plants and machinery, you stand to get 10% investment for free. That is, the government is allowing you to claim free 10% allowance for investing in plants. So it is plant and machinery or plant and equipment. Now, because you see plant and equipment doesn't mean office equipment qualifies. No, it has to have plants along with it. The rate is 10% and it does not affect your balance carried down. It doesn't affect your tax written down value when you claim that allowance. Now, the next one is the initial allowance. Now, this is the first allowance you claim when you purchase an asset. So when you purchase an asset, you claim initial allowance on the year you first put the asset to use. Let's say, for example, you bought some buses for use, or you bought some cars for Uber service or Taxify, and you start using it that year. Let's say you bought the car for 10 million naira. And you can see here, motor vehicles, initial allowance is 50%. It means 5 million can be claimed in the year you put the asset into use. That means whatever accessible profit you have to remove 5 million out of it for claiming capital allowance. Then the balance can be used to claim other allowances. So capital allowance, initial allowance, is also not prorated. By prorating, we mean that if you have 10 million naira, okay, if you have, say, let's say 12 million naira, for example, and it's supposed to last for 1 year, but you used it for only 10 months. Prorating means you say 10 months out of 12 months multiplied by 12 million naira. That will give you 10 million naira. If you use it for 1 month, 1 million. But when it comes to initial allowance, we don't prorate. We give the full allowance in that year. I like to use this kind of example to show how initial allowance works. Okay, now let's say you register for exam or you register for ICANN student as an ICANN student, and the very day they give you your ICANN student number, you are liable to pay the subscription for that year. Now, whether you receive your subscription, your student membership December 1, January 1, June 1, you pay the same 6,000 naira for that year, first year. Now, let's say you receive your student subscription and your student membership number on December 31st, 2019, let's say 2019. You will pay for the whole of 2019 year as if you received it in January 1. So you see, there's no prorating, there's no abeg. So you see, when you put the asset into use in that year, you claim full initial allowance. Now, after you've claimed your initial allowance, then you can now claim your annual allowance. So how does annual allowance work? Annual allowance, like the formula here shows, it is the cost of the assets minus the initial allowance. So when you, please, can you mute yourself? Okay. Now, when you have removed the initial allowance from the cost of the asset, the balance can be spread among the number of years that the asset will be put into use. And so each year you keep taking out or you keep claiming something called annual allowance right from the first year you start using it. To illustrate, you bought a car for 12 million. Okay, now 50% has gone. Okay, let's say it's 24 million anyway. Let's say it's 24 million. I want to make it simple. 50% gone, that means 12 million has gone. 12 million remaining. Now what it means is that if you are going to use that car for 4 years, it means for every year from the remaining 12 million, you'll be taking 3 million. 3 million each year until the 4 years complete. That is the annual allowance. Now, what is the significance of this rate, annual allowance rate? This annual allowance rate helps us to know how many years an asset should be put into use. Now, motor vehicle is 25%. How many 25 can you get in 100? Okay, if you are taking 25% of a cost or of anything, how many times will it 25% for you to get to 100? Okay, let's say you are using a 25-liter jerry can to fetch water and you want to fill a 100-liter drum. How many 25-liter jerry can will you fetch to fill the drum? 4. So that means, how do you calculate the number of years? Simply put, 100% divided by the annual allowance rate. So you see, the number of years, which is the predetermined number of years, N, because this cost minus initial allowance is called your tax written down value. This predetermined number of years is called your N. How do you get your N? Simply say 100% divided by the annual allowance rate. So 100 divided by 25 gives you 4 years. That means you will have to put 4 as your N here. Now, what is this M over 12? Now, it is the number of months you use the asset in a year. So let's look at the first year. If the first year you use it for only 6 months, your M becomes 6. So that means you will say 6 over 12, which is 1 over 2. So that means whatever you've done here, tax written down value divided by N, still have to be prorated by the number of months used in a basis period. This normally affects the first year. So the first year will have to be prorated. So the first time you are using the asset will be prorated. From the second year, your M becomes 12 because you are using it in the full year. Your M becomes 12. So 12 over 12 is 1. 1 times anything gives you the same thing. Now, let's say it's a motor vehicle. You've used it for 1 year. You've prorated. Use it for the second year. You're charging the full capital allowance. Third year, full capital allowance. Fourth year, the full capital allowance. The fifth year, that means you have exceeded the number of required years. Your M at this point becomes 0. So it's as good as if you are not claiming any assets, because 0 divided by 12 will give you 0. 0 multiplied by anything will give you 0. So your annual allowance is 0 after you have claimed your capital allowance. Now, I want to let you know that in the very last year of claiming annual allowance, you are not going to take everything. As long as the asset is in your book, to show that the asset is still in your book, you will leave 10 naira. You will leave 10 naira. Some people usually leave 100 naira. It's a matter of your principle. You can decide to leave 1,000 naira. You can decide to leave 100 naira, but the lowest you can leave is 10 naira. So you can leave 10 naira there in your account to show that the asset is still in your possession. So if you have disposed the asset, then you can remove the 10 naira from your books. Now, this is rural investment allowance. I won't talk much on that. It is the allowance you claim when you are citing your industry in less developed area. We call it rural area. There is no electricity, no pipe-borne water, things like that. And the nearest one is so far that maybe your company will want to do all this in that community. And so you can liaise with the government to claim as capital allowance those projects that you are doing on behalf of that community. Let's look at basis period. Now, basis period for capital allowance is so important. This is because capital allowance is a claim on our profit. So when you make your assessable profit, like we learned last week, is it last week or earlier this week? When you create your assessable profit for a basis period, you are now coming to claim something from it, capital allowance. So by matching concepts, the capital allowance basis period should match the same basis period with accessible profit. But there are two abnormalities that occur because we have abnormal basis period for profits. Remember the 3 C's we learned last time: commencement, change of accounting date, and cessation. They normally bring two abnormalities. We call them overlapping basis period. This is where maybe in year 1 and year 2, two period is common to them. Or we have a gap whereby between year 2 and year 3, there is a gap of some few months. Or maybe during change of accounting date, there is a gap. Or maybe during cessation period, there is a gap between the penultimate year and the ultimate year. Now, how do capital allowance handle all of this? Capital allowance is not a respecter of overlap nor gap. It does not respect overlap the way profit, accessible basis period for profit respects it. Capital allowance basis period does not respect it. And so whenever there is an overlap, this is how capital allowance treats it. Let's say, for example, you bought a motor vehicle. Your business starts in maybe June 1, 2010, and you bought a motor vehicle in June 1, 2010, or you purchased it in September 1, 2010. You know, your first year of business, which is 2010, you'll be calculating your profit basis period from June 1 to December 31st, right? Your second year, you will still be counting from June 1, 2010 down to July 30, down to May 31st, 2011. Now, that asset you bought on September 1, September 1 can be found in both year 1 and year 2. So the problem is, which year will you charge the initial allowance on? Because you can find that date on two basis period. So which one of them will you give? Will you give it to year 1 or will you give it to year 2? So the rule for overlapping is that whenever two basis period or 2 years of assessment overlap, that means there are overlapping basis period inside 2 years of assessment. That overlapped period is deemed to form part of the earlier years of assessment. So that means whenever you are comparing year 1 and year 2 in commencement, and there is an overlap, that overlap period is deemed to belong to just year 1. That means year 2 will start after 1 day after the overlap has ended. That means year 2 will start if year 1 is ending December 31st, and that is when the overlap ends. Year 2 capital allowance figure will start from January 1. So you see, there's no lapping when you come with capital allowance. It eliminates the lap. A good thing, the new Finance Act has helped us to see that profit too, we can eliminate overlapping and gap. What is gap? Gap occurs when there are basis periods that do not follow each other sequentially. Let's say, for example, during change of accounting date, one particular date ends with June 30th. Let's say June 30th, 2015. Then the new date starts from January 1, 2016 to December. Now, do you believe me that from July 1, 2015 down to December 2015, there is a gap? We can account for those 6 months. That means any profit you make in those 6 months is free profit for you. Okay, but what if you bought an asset September 1? That means that asset do not belong in any basis period, does not belong to any year of assessment. How do you handle that? The story about that means it says that, or the law says, whenever there is a gap, that gap is seen to form part of the later period. But when we are dealing with cessation rule, we have penultimate year and ultimate year. Whenever there is an overlap, we'll push it to the penultimate year. Whenever there is a gap, we will also push it to the penultimate year. So I'll restate it again. In overlap, the period of overlap is seen to belong to the first or earlier years of assessment. When there is a gap, the gap belongs to the later years, with the exception of cessation rule, where what is restriction in capital allowance? Restriction in capital allowance means that you cannot charge all the capital allowance that you claim in a year. Let's say, for example, you have 12 million naira as your profit, accessible profit, and you want to claim 10 million naira capital allowance. The law says that not all companies can claim the whole 10 million, even though you have enough profit to carry it. If you are to clear the whole 10 million, you'll be leaving 2 million for tax. And the government said, no, how can I be taking 2 million out of 12 million for tax? It's not working that way. The law says there are some companies who will just prorate their accessible profits and just give them 2/3, nothing more than 2/3 as capital allowance. So if you have accessible profit of 12 million, what is 2/3? If you divide 12 million by 3, 12 million divided by 3, that will give you 4 million. So 1/3 is 4 million. 2/3 is 8 million. So that means if you have a 10 million naira capital allowance, even though the whole 10 million can be cleared by the 12 million profit, the law says you can only clear 8 million at the time, so that the remaining 4 million, we can charge tax on it. So we simply say 2/3 of accessible profit is allowable for capital allowance. But once you are in the agricultural business or you are in the manufacturing business, nothing concerns you with 2/3. Nothing concerns you with 2/3. Whenever you see your capital allowance and your capital allowance is less than your accessible profit, charge all your capital allowance as much as your accessible profit can carry. If you have 12 million as accessible profit, capital allowance is perhaps 11 million, charge all the 11 million as long as you are in the manufacturing or agricultural business. But if you are in the trading business, you have 12 million as profit, capital allowance 11 million, you will do 2/3 of 12 million. You can only take 8 million, the balance is carried to the next year. So that is how you keep carrying the balance as long as you have capital allowance that are unutilized. You keep carrying them forward to the next year, to the next year, until you get to the point where you can clear them all. But let's assume that you cannot clear them all, and your business is about to end. In fact, you have hit the ultimate year, and your business is just ending. What do? You have some unrealized capital allowance. The government is saying that if you have unrealized capital allowance, we can still help you. Instead of carrying your capital allowance forward because you don't have any business, start carrying it backward. So you are in the ultimate year, you carry it backward to the penultimate year. You carry, if you charge again, you carry it backward for 5 years. If 5 years cannot clear all your outstanding capital allowance, after the 5th year, any outstanding is lost. How do you use carry back? This carry back, you do it as follows. As you take it back, you are reinstating your capital, your taxable profit from which you charge your tax. The tax authority is refunding you your tax so that you can now claim capital allowance. If you cannot claim it, you take it to the next year, the previous year. Excuse me. You take it to the previous year and you do something similar until you take it for 5 years. And if you cannot claim it, it becomes lost. Now let's look at exercise 2.1 and let me show you how to calculate basis period for capital allowance and how to compute capital allowance. James Nigeria Limited commenced business as a textile manufacturing company. Now, this is the nature of business. You can trace it that it is a manufacturing company. What does it tell you about capital allowance? No restriction. No restriction. You can take all the profits to go with your capital allowance if it is possible. Now, that's one thing you should mark. Another one here is commenced business. So you are dealing with a commencement period. And in commencement period, there will be a lot of overlaps. There will be a lot of overlap. So let's see how the overlap is treated. Oh, sorry, I'm so tired. So tired. All right. This is the date the company began business, June 1, 2001. So for profit, accessible profit, for basis period for accessible profit, this date is used twice, the first year and in the second year. 2001 is our first year because that's June 1 is when our business started in 2001. Now, look at the basis period. They are bringing the accounts March 31st every year. That's fine. Now look at the capital allowances and look at the amount spent on capital allowances. Now the question is, determine the basis period for profits, accessible profits. Assessment means accessible profits. And for capital allowance for the first 5 years of assessment. How do we do this? Let's get to our solution. And this is the solution. This is the basis period for profits and the basis period for capital allowance as we are instructed. Now, how did we get this table? Now, let's watch closely what I did. Year 1 is 2001, right? The business commenced in June 1, 2001. And so for the first year, business started down to 31st December of that year. We also begin from the date the business started, after the business started. So it will end in May 31st, 2002. Year 3, that is when we'll start doing the preceding year basis. So this is 2003, yeah? That means it must end in 2002. Then we ask, when is the account being made? The account choosing date, the choosing date for accounting is March 31st every year. So if you attempt to put March 31st here, I didn't put March anyway here, I put May. But let's assume we put March. What happened? If March is 1, 2001, and that would have been correct. But the problem here is the business has not started in April. The business started on 1st of June. And so that analysis cannot work. So you cannot get 12 full months in year 3. So what do? You go back to year 2 and repeat exactly basis period of year 3 of year 2 into year 3. So that's what you do. You repeat year 2 into year 3 whenever you cannot get 12 full months on preceding year basis. We go to year 4. So since we cannot achieve what we want to achieve in year 3, from year 4 we start achieving it. Look at year 4, 2004. Your preceding year basis must be 2003. Account ending date now is March 31st, in line with others they are giving to you. That means it must have started in April 1, 2002. Perfect. And so in 2005, all you need to do is where 2004 stops, 2005 continues. So you see there is no overlap between 24 and 25. Another way of doing it is just copy that of 24 and paste it in 25. All you do is increase the year. Year is 2002, increase it to 23, yeah? Year is 23, increase to 24. That's all. Give me a moment. Okay, now let's look at capital allowance basis period. Capital allowance for the first year is always the same as that of profits. It's always the same. Now let's look at the second year. In the second year, there is always an overlap between the first year and the second year. This is because if you look at June 1, 2001, you can still find it here. Moreover, you can still find it here. So it is even here we are going to look at. This date, you can find it here. You can find it here. So that means it doesn't qualify as a starting date because there is going to be an overlap if it starts. Let's look at the ending date. This is 31st May 2002. If you look here or here, you find out that this date cannot be found here. So that means it qualifies. There is no overlap. So you take this 31st May 2002 and put it down here. 31st May 2002. So you have decided on the ending date. This starting date does not qualify. So what do? Go to the previous capital allowance. This is 31st December 2001. What is the next day? Tomorrow's date is January 1. So that's what you use here. January 1, 2002 becomes the starting point for your capital allowance basis period. Now, if you look at 2003, this is an exact copy and paste of 22. So there are bound to be exact copy, exact overlap. So you can find 2001 June year, and you can also find 31st May 2002 here. So it's an exact overlap. For capital allowance is dash. Okay. Then for 2004, look at April 1, 2002. Of course, you can find April before May. So April and May are overlapped here. So this April does not qualify. But look at this 31st March 23. You cannot see it anywhere. So it becomes your ending date. So what would that become your starting date? You have to look at here and ask, what is the next date after this? June 1, 2002. That's your capital allowance. So you see year 5, you can never see the starting date inside here. So there's no overlap on the starting date. Then you have to check again. Is there any gap? So even if there's no overlap, check if there is gap. How do you know there is not going to be a gap? See this one? Ask yourself, what is tomorrow's date? If tomorrow's date is this, it then means that there is no overlap. So it qualifies to start. And so this also qualifies to finish, because there will be no overlap. Neither will there be a gap. Now look at the assets you bought in those period. This was bought in March, even before the business started. This was bought in May 2001 before the business started. This one was bought in October after the business has started. So you can see the 3 of them here. These 2, factory building and machinery that was bought before the business commenced, they are treated as though it was bought on the first day of the business. So even if you bought it in March or in May, as soon as the business starts in June, that is what you can claim as capital allowance. That as if it was bought June 1. The furniture that was bought in October, it has no problem. We handle it in 2001. Then you get to 2002. You look for assets that was bought within January to May 2002. Between January to May, we have motor vehicle and delivery van. So these two qualifies as the asset to be used. In 2003, the basis period for capital allowance is dash, so no assets qualifies. In 2004, we are looking for June 1 to 2 to 31st March 23. So this qualifies as capital allowance. Okay. When we look at 2005, there's no basis period where we bought anything in line with this. Okay. So now let's look at the B part of the question. Compute the capital allowances due for 5 years of assessment in respect of the qualifying capital expenditure incurred by the company. So in respect of the capital expenditure incurred by the company, which are all these here, we are asked to look for the capital allowance for 5 years. How do you do it? Let me quickly run through it. In the first year, now what we've done, we've brought from the other table, we've brought the basis, the year of assessment and the basis period for 5 years from capital allowance. We've also brought the expenditure, qualifying capital expenditure. Now, let's see how we can calculate our initial allowance, our annual allowance, and our total capital allowance. Look at factory building. Factory building, we are told, cost us 3,500,000. That's this, 3,500,000. I want to keep open the capital allowance rate so that you can see it. Okay. Now, factory building, the initial allowance rate is what? We look for industrial building. Industrial building is factory building. Initial allowance is how much? Is 15%. 15%. So that's what we did here. We look for 15% of the building, and it gives us 525,000. So can you see here? We have our 525,000 here. We look at machinery. Machinery is 50%, according to our book, 50%. So now you trust what I just did. You look for 50% of the costs, and that gives you 1,400,000. We've written it here, 1,400,000. Then we go to furniture. It's 25% of the costs, 187,500. That's what we did. Added them up, and they gave us this. Okay, so this is our initial allowance considering the three assets together. Let's look at the annual allowance computation. We said that the factory building were bought June 1 when the business commenced, were deemed to be purchased on the date the business commenced. So factory building and machinery, they are seen as though they were bought in June 1. If you look at our basis period, is from June 1 to December 31st. I think I may need to open somewhere. So let me just keep this table open. Now we're looking for annual allowance. How do we calculate the annual allowance? The annual allowance is calculated as follows. Bring your costs and you remove your initial allowance. Then you take the 100% divided by the annual allowance rate of 10%. You are looking for how many number of years. So 100 divided by 10 gives you 10 years. So it means this cost minus initial allowance divided by 10 years will give you 297,500. Now that is the full amount for a particular year. But you didn't use the asset for full year. You use it in just 7 months. So you prorate that full amount by 7 months. So you prorate 297,500 by 7 months gives you 173,542. You do the same thing for machinery. After getting the full cost for machinery, you look for 7 over 12 of it. That will give you what we use for the first year. So that's what we did. That's what we did for the first year, the two assets. That's what we did. Okay, going now to furniture. Furniture was used in just 3 months in the basis period. So after getting the normal yearly figure, we prorate it 3 over 12. And so that's the figure we have here. So when we add them together, they give us total annual allowance alone of 405,834. So when you add it to the initial allowance, you have a total of 2,517,834. Now that's the first year. Let's go to the second year. The second year, you bought some motor vehicle and some delivery van, and so you still need to do your initial allowance again. Motor vehicle and delivery van, their initial allowance rate is 50%. So look for 50% of 500,000, give you 250. Then motor car, 50% of 1.2 million gives you 600,000. And that's what we had here. 250, 600,000. So what happened? We add them up, you have your 50,000 as your initial allowance. Okay, annual allowance, what do we do? For year 2002, we look for delivery van costs minus initial allowance divided by the predetermined number of years. That gives you 62,500. But we are going to prorate the first year. We are using the capital, you are using the delivery van, which is in 2002. We are using it in 4 months, and so you prorate it 4/12, and that takes care of it. Do the same thing too for motor vehicle. Costs. There is a cost minus initial allowance divided by the number of years. That will give you 150. Then for that first year alone, you can prorate the 150 by 1/12 because it's only 1 month to the asset to use. That is 12,500. Now, that's what we did. 12,500 for motor car, 23,880,833 for delivery van. Now, what is this 760 all about? This has to do with assets that were acquired in 2001. So look at how it is being done. After calculating the second year, the 2002, this is the delivery van we just calculated. This is the motor vehicle we just calculated. The others, like factory building, instead of prorating again, which we did before, you charge full. Instead of prorating the factory building machinery, which we did before, we charge it full. And of course, the furniture, we charge it full. Add them together, you have 760. And that's that 760 we were talking about. You add them up together, you have this figure as your annual allowance. You add these other two together, you have 850 as your initial allowance. When you add initial to annual, you have your full figure here. For year 3, there was no assets bought. Since there was no assets bought, there will be no initial allowance. But what about annual allowance? All the assets that you were doing full. For example, asset purchase in 2001. You know how we got our 760. These are it. Then the asset you bought in 2002, delivery van and motor vehicle. So you are going to bring the unprorated parts. That's the full version of assets purchased in 2012. If you can remember from my workings here, is this 62,500 and is this 150,000 that I'm featuring? 62,500 and 150. Add them together, you have 212,500. Add it to 760, which is assets from previous year, you have 972,500. So that's what you use as your capital allowance. Okay, let's go to the number 4. You only bought office equipment. That will mean that in 2004, you charge initial allowance, 50% of 600 will give you 300,000. That's what you just did. Okay, then you calculate For that 4th year, we will calculate the annual allowance. The annual allowance is cost minus initial allowance divided by 4 years to give you 75,000. But since that's the first time you're using the asset, you prorate it and it gives you 18,750. And that's what we have here. Then, as if that is not enough, all the assets purchased before 2004, you bring their capital allowance. For example, for asset purchased in 2001, 760, asset purchased in 2002, 212,500. They add up to give you 972,500. So that's the 972,500 that we have here. So if you add them up together, it gives you 991,250. And your total capital allowance will be initial allowance plus annual allowance. Now let's go to year 5. In year 5, we didn't buy any assets. And so we had no initial allowance. It's only annual allowance we have. Okay, so what do? Look at the calculation for 2005. These are assets bought in 21. These are assets bought in 22. And this is the asset you just bought in 24. Add them up together, it gives you 1,047,500. That's what you have here. Since there is no initial allowance, you add them up, it becomes this same value. So I want you to go through all these workings and go through them so that you can understand. Now, the last question says, compute the company's tax liabilities for the first 5 years. So I'll be taking it a bit of a rush because you know how to do your tax liability. All you need to do is use the basis period for profit. Your assessable profit, which you are given in the question, is 3,500,000. Okay, so but what will you do? This is assumed to be from, okay, sorry, this is your capital allowance. Is 7,500,000. Your assessable profit 7,500,000, and you need from June to December. That is 7 months, and you are given a 10 months figure. So what do? You say 7/10 multiplied by 7,500,000. That will give you your assessable profit. Then you will come here and pick the capital allowance. You come here and pick the capital allowance and plug it in. When you plug it in there, you less it, you have your taxable profit. It is from there you find 30% of it to get your tax in company income tax. Your education tax is 2% of assessable profit. You add them, your total tax liability is all this. Now, in your second year, you are still taking figures from here because you are going to still use from the date the business started. So, but this time around, you are looking for 12 full months. Since you are looking for 12 full months and they give you 10 months, you take the whole of these 10 months plus the remaining 2 months can be gotten here, 2/12. That's what we did. 10 months plus 2/12, 12 million, everything give you 9,500,000. Your capital allowance you go straight and pick it from here. Okay, that's what we did here. You picked it from here. You less it. You have your taxable profit, which you charge tax, and your capital allowance and education tax is charged at 2% of assessable profit. That is also the same way you do year 3, year 4, and year 5. So kindly study the examples we've given to you here so that you can understand how we formulate basis period for profit, formulate basis period for capital allowance for the sake of initial allowance. Then how we apply them in getting our assessable profit and chargeable tax, and to calculate your education tax and company income tax. Okay, I would like you to go through all of these. In our next class on Saturday, we'll look at question number 2, which is a bit complex. And I will show you how you do what they call carry back of capital allowances. How you can carry back capital allowances when you have met a cessation of business. Then after that, we'll be entering into what we call losses, how we can handle losses, loss relief. We'll touch that one in brief, and that will be all on Saturday. So keep a date with us, 7 o'clock on Saturday, when we'll be doing a brief overview of what we've learned today and continue from question number 2. So thank you so much. If you have any question, please send it to the WhatsApp group. I keep saying send your question. People have not been sending question. Perhaps it is 1 week to the exams. So I'll see people sending me questions. So please send your questions and I'll be glad to handle them. Thank you so much. It's so impractical, it's so impossible for me to continue now because I'm so tired and exhausted. I need to take a well-deserved rest and sleep. Thank you so much. I've uploaded the material for today's class. I've uploaded it in our refreshers class. So please go through and look at the questions again and look at the materials. If you don't understand anything, call my attention. In my spare time, I'm going to look at your question, and I'm going to look at your question and answer them. Yes, our YouTube, yes, the person in charge will do that. That's likely going to be coming up tomorrow. It's not going to be done tonight. It's going to be done tomorrow. So, but look at the questions, study it carefully because it is important that you do. Thank you so much and have a good night rest. See you again on Saturday.